All right, very good. Okay, it is January 12th. This is the WealthVest Bull&Bear. I'm Tim Parati. I am joined as always by Drew Dawkin, who is today representing the Montana State Bobcats, the
National
football
champs, man.
championship series national champions. Congratulations to everybody in Bozeman on that. Aahan, I'm sure you were super focused on the Montana State Illinois State game.
Not as much as I'd like to be.
All right, so listen, I'm a big fan of Ahan's work. I've seen him on a number of podcasts, and he's been kind enough to share his work with me. And I think what's interesting about Ahan, there are a lot of independent research firms that we talk to and we've had on the podcast. And I think Aahan is one of those guys who you're going to be seeing a lot more of as kind of a dominant person in the world of sort of independent macro research and trading research. So really, thank you for joining us. I thought what we would do to start is just talk a little bit about your background and how somebody who looks as young as you look has come to build this business.
Um, well, first off, thanks for having me on. I'm excited to be here. I've listened to, been listening to some of the podcast, and I really enjoy the content you guys are putting out there. It's a real value add to the space. So I appreciate you having me on. In terms of, my background and Prometheus, for those that are unfamiliar with me, maybe I'll just intro Prometheus really quick. So, I founded a firm about 5 years ago called Prometheus Research. And what we do is we do systematic macro, right? So we do what, your favorite sell side analyst or macro strategist does, where we're looking at growth, inflation, projecting, all kinds of different macroeconomic variables. But what we really, really specialize in is taking macro research, making it more quantitative, systematizing it, and creating rules-based, durable portfolios for a variety of audiences based on our quantitative proprietary process. That's really kind of like the source and what makes Prometheus different from other typical macro research. In terms of the path to kind of getting here, Prometheus is basically the culmination of a lifetime passion for macro markets for me. As you noted, I still have the fresh face. I don't know how many more years this is going to last, but I have it for now. But I often joke that I've had an investing career that is twice as long as my professional career. So, I started my professional career in 2018, which puts me about 8 years into my professional career. But I started investing in late 2008. So I was about 13 at the time. And obviously there wasn't much skill involved, but I had a very Ray Dalio-esque story through luck where, my grandfather was an active investor, and he portioned out some of his money to try and build some good habits for me to start, investing really young. And so I started trading the Indian stock market as part of, a sub account for him when I was 13 years old. And, the first couple of stocks I bought just took off. They went to the moon, and I said, man, I'm really good at this. This is a great way to make it happen. Yeah, this is, I don't know whether it's the best thing that happened to me or the worst thing that happened to me. But I thought I was a genius, and, the inevitable kind of turn happened. And I think that was really kind of like a fork in my life where I could have gone two ways. I could have said, man, this thing is too hard. It's not as easy as I thought it'd be. I'm going to do other things. But I kind of became really intrigued about how to, continue to generate positive performance, and that kind of curiosity started at that age and kind of just stayed with me for the rest of my life. And so, I also happened to start investing just around the post-financial crisis period. So we were still having the Eurozone crisis. We had just come out of, the global financial crisis. And so macro was a really big thing, right? Like macro was a really big thing. And because macro was such a big thing, I wanted to know what all the best investors were doing, or who were the best macro investors. So I got really influenced by, reading all of Soros's books and Ray Dalio's book and all of that, and became very, very interested in macro from a very young age and wanted to kind of go into that as a business. As you know, as I started to learn a little bit more, I remember I ended up going to university very much to study economics and finance. I majored in finance, but uh, even in college, I started to build my own models. So I started to actually, I still think I have an Excel spreadsheet which was trying to use CPI data to trade the S&P 500. It was a horrible model, but I still have it as kind of like a memento of the time. And
Now,
so
was
what for
that,
me,
if just to interrupt, was that driven by, one of the things that you learn when you read Dalio and you read Bridgewater is, I don't want a good idea. I want a process that will generate many ideas. So is that where you kind of got the idea of trying to be quantitative in creating a system, or in the term you use, a program?
yeah, absolutely. And that was like the foundation, right? That was the foundation of what, and I think a lot of what uh we have today that may be different from what other people have or other businesses have is just that when I built those models, so first off, I was not quantitatively sophisticated enough to build good models. But I did know that there were people doing very, very good things in the business based on these ideas of quantitative diversification, right? The only thing that I think that really lend itself to the business becoming what it has is staying with those same questions consistently over the course of 10 plus years, and so I think that the idea of having a quantitative approach to macro was something that was really, really foundational to me and has stayed with me through my entire career. After I graduated, I actually ended up going and working on the institutional buy side for a global macro hedge fund. And that was one of the best experiences in the world because it happened to be a hedge fund where, we started, it started a couple of years before I joined, but, it started with a good deal of hype. So, they had raised a healthy amount of money and, they were backed by the right people and they were from people that had a lot of experience on the street. But for a variety of reasons, they had a tough time kind of getting the P&L to really ramp up, and they ended up shutting subsequently. But interestingly, they want a quantitative macro shop. It was a discretionary macro shop, and my mind was had already been sort of formed in this quantitative, super diversified kind of way. And it was really interesting to see the completely different side of macro, where we're doing concentrated, thematic, option-based structured bets across, in a few markets,
Mm.
and really trying to isolate the big themes that matter. And it was really, really, interesting to kind of learn a different aspect of the business. And then from there, I ended up transitioning into a very different role with kind of a similar theme. I ended up going to work in research at a retail FX firm, a retail
Mhm.
FX brokerage. And over there, I had a really great opportunity in that I was given complete latitude to basically uh, build out their research business, right? Because they found a guy from a hedge fund, who knows stuff about macros. Said, okay, we're primary retail, but we want to start to attract more of an institutional audience. What can you do for us? And so I had a lot of leeway to really start building my own ideas and my own models and things like that. And, I obviously retained all the IP from that time as well. And so as I went through that process, at some point, all of the research I'd been doing and, the persistence of kind of trying to create these systematic strategies for global macro markets began to accumulate into what became the initial models for Prometheus. And at some point I said, okay, I've built enough IP. I think that there's a solid market. And just, I think in the post-pandemic period is basically when I said, hey, it's time to go leg it on my own. And I started Prometheus. Interestingly, I started Prometheus as a completely free and unpaid blog, right? And very quickly, this was before Substack is what it is today, where there are a million newsletters, and I think there were maybe you could count on your hands the number of macro newsletters there were when I
Sure.
first started writing Prometheus. So very quickly, it turned out there was a very big institutional audience reading Substack, and so they ended up becoming my first institutional clients. I'm happy to say a lot of those relationships have persisted till today. And fast forward 5 years, now we have one side of the business an institutional business, and the other side of the business a retail business, and that brings us to today. So that's the backstory.
Yeah, it really is a fascinating backstory, and it's so differentiated. You were able to kind of create this to some degree on your own. It wasn't like I'm a former Bridgewater guy and here's how I do it. I'm a former D.E. Shaw guy and this is how I do it. You're offering something that you've kind of created organically for a decade.
Yeah, it's been a lot of good fortune and some amount of persistence, and me just being really, really keen and interested in macro for a long time. And I have had I have been able to, both through, working with these institutions, having worked at, a big global macro hedge fund, and also having some mentors along the way, I've been able to also kind of tap into what the best institutions are doing and really use that to kind of shape what we're doing at Prometheus.
We brought up Ray Dalio before, and he's obviously such a voracious student of economic history on kind of the qualitative side of things, the changing world order, the coming debt crisis. Do you find yourself kind of studying cycles of booms and busts, on a historic level? And does that, put any frame into, how Prometheus thinks about things as well? Or,
I would say Ray has, I think that if you took Ray, maybe I don't know Ray, but I think if you wound back maybe 20 or 30 years, I think that Ray would be talking about much less big picture things. And so I think the day-to-day of what happens at Bridgewater or any major global macro hedge fund is very, very different from the big 150-year cycles and all that type of stuff. And so I think as I have progressed, I think that there's a progression to it, right? Like when you start, the big picture ideas are very, very appealing, right? Because they're super intuitive. But as you go on this path of trying to generate strategies for your various clients and maximize P&L, what you start to realize is that the majority alpha is in mid-frequency things. It's in mid to short frequency things. And, you're going to start. So, I say this quite often. I spend much less time reading books now than I did maybe, 10 years ago. And I spend way more time with data than I do with the books and the big picture stuff. I think maybe, if I'm in the business, if I'm lucky enough to be in the business another 40 years, then I'll probably gravitate back towards that side.
No, you're right. I mean, Dalio had to put up monthly returns, right? I mean, you could talk about big debt cycles, and he still believes in a big debt cycle. Sort of all of them do. But, that's not how you're going to make your business. That's not how you're going to differentiate yourself, driving returns, driving probably uncorrelated type returns. I thought one of the, and we're not going to, and I should just say it, this isn't investment advice. This is for educational purposes only and so forth. So we're going to get away from talking about your performance, which is pretty impressive. But what stands out is the drawdowns are minimal. Right. And your experience at working with guys who sounded like they had big differentiated views, they were going to make big bets, they were going to be the next George Soros. You kind of saw that and said, you know what? You got to hit singles in this business. And what kills you is the drawdowns. Is that right?
Yeah. I mean, I think that's something that all our strategies kind of like adhere to that principle, right? Like, we don't, I think what most people don't realize is the kind of like Sharpe ratios that are required to generate, just years and years and years of outperformance without a single year down is way higher than what, your average retail investor is experiencing. And the only way to achieve that is not by being right all the time. Like you don't achieve extremely high risk adjusted returns by being right all the time. You can for short periods of time, but what really allows you to do that to achieve high Sharpe ratios. And so when I say high Sharpe ratios, what is a high Sharpe ratio? A high Sharpe ratio is, in a 1 to 3 range. That's a really high Sharpe ratio. Those are the kinds of numbers that the biggest hedge funds in the world put up. Usually a lot of those numbers are before fees and before, taxes and things like that, but that's still a really, really attractive return stream. Most funds that are doing that through a tremendous amount of diversification, rather than saying that, hey, like every year we just nail every single call and make a ton of money on these calls. And, I think it goes to the idea that, especially as you get more high frequency in your views, which is kind of essential when you want to generate a good amount of alpha, your batting averages are just going to come down, right? Like, so if I tell you, hey, like I need you to predict the S&P 500 every week from now using, these 10 models, you're not going to get it right 60% of the time. You might get it right 52% of the time. But if you can do that across a variety of markets, you know what happens? You might maintain that average 52% hit rate across strategies, but your volatility collapses. And if your volatility collapses, usually your drawdowns also collapse alongside that. And so that's really what you're trying to do. You're trying to basically play this game of like, I want to be pretty good at a really wide variety of markets, but when then I put it together in aggregate, I look, really amazing and like I don't get things wrong.
Yeah. Yeah. That's a good point. I mean, a lot of guys can put up a 2, 3. I think 1 is considered like a successful Sharpe ratio. And there are a lot of guys who have years where they put up 2 and 3. But there's very, very few guys who do it for a very long period of time. And again, that all comes back to having a process that is kind of drawdown centric and diversified and manages volatility. Let's move on to kind of the macro discussion here. You were on Forward Guidance recently. That was a great conversation. And you have a, kind of a bullish overall view, but you got into the discussion and you used the word divergence, the big divergence around kind of labor and nominal growth. I think that's a fascinating conversation, and it's such an unusual period, right?
Mm-hmm.
That I think that your take on it was really interesting. So I'd kind of like to start there on the macro discussion.
Yeah, I think it's when one of the weirdest times that we've ever kind of lived through, at least in, you could say probably over the last 80 years, we haven't seen this kind of divergence. So maybe I can paint a picture of what that divergence is. So just TLDR, the divergence is basically between output, which is GDP, real GDP, and the level of employment. And what you have today is basically a situation where real GDP growth is extremely strong, or over the last 2 or 3 quarters, really strong. But you have employment, and we have certain ways of adjusting the employment numbers. But even if you take the employment numbers as reported by the various agencies at face value, employment is pretty weak. And that's the divergence that we're talking about. And that divergence is extremely anomalous. What makes that divergence anomalous? So when you kind of take a step back and you think about what GDP growth really is, GDP growth is really just the number of workers times the number of hours they've worked, times their productivity per hour, right? And there tend to be, when you look at the variation in those things, the productivity component tends to be something that's very smooth and slow over time. People don't become more productive one year versus the other. Just, it doesn't explode and change, year to year. It tends to be a very, very kind of slow time trend to productivity. When it comes to the number of hours worked, you see a similar dynamic. It's a cultural phenomena. People in the US tend to work a lot more. People in Europe tend to work a lot less. People in emerging markets are somewhere in between. It's a cultural phenomena. The thing that ends up driving GDP variation, anybody that's exposed to macro knows that GDP can be pretty variable in any given year relative to the last. The thing that ends up driving GDP variation is actually employment. It's, how much employment changes. Now, within employment, you basically have 3 different variables that drive employment. And those 3 variables are the total population, the participation rate of that population, and then the hiring or firing rate, which is just the unemployment rate, right? And so what happens over time is that the population tends to trend in a nice, smooth fashion. It can have some changes up and down based on immigration flows, which we'll talk about. But over time, it tends to be a very smooth process usually. The thing that ends up driving most macroeconomic cycles, so the things that we like to trade, that financial advisors are looking to time, those types of things, are changes in the unemployment rate. So those changes in the unemployment rate are basically responses to business cycle conditions, where basically businesses see, changes in profits and earnings expectations, and, really expectations for their own businesses, and they increase their hiring, or they'll begin to lay off people. That's really what causes cyclical variation in the economy and what has usually resulted in recession. So what drives recessions and slowdowns of the economy is basically the unemployment rate, which flows through to total employment, which drags on GDP growth. Today, we have a really, really odd circumstance in that complex, which is the unemployment rate is rising, but very modestly. But what we have for the first time in maybe 60 or 80 years is that the population and participation rates are beginning to fall off quite dramatically, which is a weight on aggregate employment. And that has not yet had any impact on GDP, but it is very, very hard for the economy to diverge very materially from what the labor market is doing. And so we have this situation today where an immigration-induced policy change has begun to weigh on the total labor force and the participation rate. And that's creating an employment backdrop that just really, really doesn't look ideal. Meanwhile, you still have output just going like nothing's happened at all. And our expectation is basically that those two things are eventually going to converge. Which way they converge is, it's a matter of nuance and interpretation. Our bias is that it's probably that output is going to converge down to labor a little bit more. But that divergence that exists today is not something that we think is sustainable.
It's an interesting. Oh, I'm sorry. Go ahead, Drew.
When we talk about participation, there's a couple stories here, right? We talk about the immigration story, but then also a lot of 75 and above have left the labor market after years of strong stock returns. And then Gen Z just is having a really tough time getting a job, it seems. So, which narrative is the most important? And then also, do all these factors together just kind of create a sticky wage situation?
Yeah, when we slice and dice the data, what we're seeing is to be clear, when it comes to, so there are basically these three levels these three different components of total employment, right? Like, so there's the total population growth, there's the participation rate, and there's the unemployment rate. What we find is that the participation rate and the unemployment rate are pretty they're pretty reliable in terms of the data fidelity. Like, you can believe the participation rate and the unemployment rate because they're unrevised data. They'll stay like that forever. The population numbers are, they're a little sketchy in that you basically, this is, these are the household survey numbers. So every year you have the census, and the census numbers in January, so, coming in February, will revise the total population numbers quite dramatically. So, it's a little bit tough because all of the numbers impact each other. So the population numbers will flow through to the participation and the unemployment numbers. But to get to your question, the thing that we're seeing in the data really is that if you do believe that the immigration policy of the current administration is having an impact on labor composition, what's happening is that you're having a recomposition of the labor force from foreign workers to domestic workers. And domestic workers tend to have much lower participation rates than foreign workers. And so that recomposition explains almost all of the change in participation rates today. And so, without looking at the population component of it, if you just isolate for the participation and say, hey, like, does this recomposition, it basically mechanically tells you that, hey, you're going to have a lower participation rate because you have this lower foreign base. With regards to the wage stickiness, I think the wage stickiness is a little bit harder. I'm not in the camp of wage stickiness. To a certain extent, right? Because what we're seeing today is we're seeing economic activity that's really, really hot, but we're not seeing it actually translate into very, very tight hiring just yet. There seems to be an unequal distribution of the way wages are distributed amongst the consumer. And so we're not necessarily very, like, I wouldn't say I have a very strong opinion on the wage stickiness part.
I just learned something there. I had never heard that before. It makes all the sense in the world, though. The cohort with the highest likelihood of being in the labor force at like 95% is immigrants, right? So if you remove immigrants, you are just kind of mathematically going to have a lower participation rate. Yep. On the stickiness, it is interesting in that you have, like, the NFIB, the National Federation of Independent Businesses, will come out and say somewhere in the neighborhood of 40% of companies can't find a worker to fill an available job. And it just seems that you now, and part of it is the lack of immigration, but where you have a lot of industries that are really strained for labor, and yet you have other industries, maybe introductory white collar jobs that are really very soft. And we just have a labor mismatch. And we have this phenomenon where you could have almost no labor growth, very little hiring, and yet have some stickiness in a number of industries.
Yeah. Yeah. I mean, that's definitely the case. And, you see even more interesting divergences in some other areas. So, for example, one of the hardest areas of income growth is professional and business services income growth, but it's also the worst industry for employment. Which really just points to kind of like this these increasing divergences. And I think there is a lot to the AI story as well, right? So if you think about a lot of the wage beneficiaries of AI are in professional and business services, right? So they are actually seeing real income growth really, really dramatically relative to the rest of the economy. But in other places, you see much, much slower real income growth. And so I think that, the last probably 3 to 5 years have been a situation where you increasingly under macroeconomic aggregates have started to see these really, really wide divergences in outcomes. And you see that kind of manifested in, popular media and just the general kind of sentiment today as well.
Yeah. I put out a blurb that Torsten Slok, who's been on the podcast, put out today, where he showed the Duke CFO survey that said basically 70% of CFOs are seeing no productivity lift, and another 15-20% are maybe seeing 0 to 5%. So pretty negligible. But it does strike me that if I'm a CEO, I am going to be judged based on my ability to integrate and find efficiencies from AI. So if I'm not really growing and I want to, and I got to drive margin every year, right? I am going to talk about AI being the reason why I can generate X with fewer employees. And I think that it comes down to, like, there has to be some reality here. We got to get there pretty soon, or else you're going to have companies that are basically understaffed.
Right. I mean, I think and that's the hard thing, right? With the AI, with the AI investment, I think that, I've talked about this before, but I think that the AI investment in itself is very, very stimulative just by its own nature. But at the same time, at some point, you do start, once you get past the point where the AI is completely cash financed, and you start getting into a point where, okay, to stay competitive in AI, people have to actually start levering up their businesses and, are actually borrowing to finance this AI, which is started in a very, very small way, not in a big way. Then you really, really start to come up on the kind of physical constraints of like, okay, this needs to turn into some kind of broader real output. But then you continue to maintain the challenges, right? I think we have a common friend, Bob Elliott, right? And I think he's talked about this on various platforms really well, where more AI investment, regardless of how good it is not going to make people buy more cars and washing machines. And so that's a very, very real kind of capacity constraint. And regardless of how productive we become, there is a limit to how much we can push our overall productivity and output.
Yeah.
So, last month this kind of leads in, I think, a good segue to this. You were on the Market House and you're saying earnings expectations are really hot, but at the same time, the pace of the growth isn't there. And AI is a good example of this. So what do you think that means, in terms of equities for this coming year, for 2026?
Yeah, I mean, so the way we do things is not like, we don't have very long-term views on stuff, in the sense that, we don't project 1 year forward and stuff like that. But I think generally what we're seeing today is increasingly a situation where aggregate earnings expectations are just starting to look rich to what the economy can actually deliver from the business cycle. And what that does is, like, that doesn't put you in a tremendous short everything kind of bucket, but it does put you at a point where there is limited upside to how far you can go. And so what you need is, you need one of two things to happen, right? Like, you need equity prices to correct a little bit, or you need, some big change to what the economy can deliver. And right now, we just don't see the business cycle as, like, there was a time, maybe, after Liberation Day, where earnings expectations were were probably a little beat down relative to what the economy could deliver. But since then, you've basically had a very, very strong rebound, which is almost entirely driven by the tech piece. So if you look at the rest of the index, you don't actually have very, very good earnings expectations growth for the rest of the index, but the tech piece is actually leading most of the growth. And so as a result, you have the aggregate S&P 500 earnings expectations up a lot. We think that that's a little bit rich. And so what that really boils down to in terms of equities is like, until you get, better prices for the amount of growth that you're having, you're in a little bit more of a challenging environment relative to 2025.
Say that again. Better price. Say that last piece again.
Yeah. Better prices relative to the ongoing earnings growth, right? So we think that the earnings growth that's expected is a little bit rich. And so until that, that balance between prices and expected earnings growth improves a little bit, you probably have a little bit more of headwinds for equities than, you did in 2025.
Yeah. I mean, you had said earlier, usually productivity is pretty smooth and it's in a pretty narrow band, right? It's kind of 1%, 2%. Over the last 30 years, if you asked economists, what do you think productivity would be? They'd say 1 or 2%. And now we've had these quarters where you've had, no employment growth and yet huge earnings growth. And that blows out the margin number and the productivity number. So but you've also talked about, look, profitability drives capex, drives profitability.
Yeah.
And that capex is so concentrated in one area. The bet Wall Street is making is, you hear this, if you turn on CNBC and you hear 5 strategists, they're all going to be bullish and they're all going to talk about a broadening out. It's going to be a broadening out of the earnings growth. And that is because they would argue that's because AI implementation is really going to start driving that growth. And I guess that piece of it is unknowable, but it's a big bet to be making, right? It's already priced into multiples. It's already priced into existing margins, and it's priced into record margins on top of record margins.
Right. And I don't really like when you watch a lot of like commentary around when in the aggregate sector earnings and the expectations and stuff like that, they basically follow price momentum of the individual like sectors. So it's like if the sector's been up a bunch, so for example, financials are up a bunch. Now everyone thinks financials are going to be one of the biggest AI beneficiaries on the planet, right? So it's that type of narrative when it comes to these things. When you actually like peel it back a little bit and look at, say the sectors that are really exposed to more traditional business cycles and things like that. So industrials, energy, materials, all those kinds of sectors. Yeah, they're doing terribly. They're doing terribly in terms of their earnings expectations and their contribution to aggregate earnings expectations. They're just not in a very good spot. So I think when you compare those earnings expectations, you add in what the macro aggregates are actually telling you about the fundamentals for those earnings, it doesn't look like we're seeing this diaspora of, AI productivity to every sector in the world. And so, I think it makes sense to be, I think it always makes sense to be skeptical. But I think that perhaps today, given the expectations that are beginning to be priced in, it makes more sense to be even more skeptical.
Yeah. I mean, and I couldn't agree more that if you watch Wall Street Bank Research, you watch the analysts come on, they're going to draw a straight line out from, we're at 6,800, we'll get 12% earnings growth. That means we'll go to 8,000, and it's really just not terribly helpful. And you've had one of our mantras is, look, we don't predict the future because we know we don't know the future and we know nobody else does. But and I think that is a mantra for you as well. And again, it brings us back to why a repeatable process is so important to everything you do. Do you get frustrated if you happen to make the mistake of turning the volume on CNBC and listening to some of the commentary?
I don't watch any of it, so I don't have it running anywhere. I don't have I don't have the chance to get frustrated.
Oh, well, that's wise of you. Let's talk a little bit about inflation. I won't get into what you've shown me in terms of positioning, but it looks to me when you look at how you're looking at the housing market, how you look at tips, for instance, that you've got a view here, at least in the near term, on inflation.
Yeah, I mean, we have, so just to give a bit of backstory on this, the way we approach things, particularly in our institutional setting, is we have positions generated across 50 different global markets, right? And the good part about that, particularly when it comes to inflation, is that inflation is basically like it's the sum of let's say 3 or 4 major areas. So I would say that there's energy, there's housing, there's transport, and then there's the services component. And we can actually have views generated for each one of those things individually, right? So there are different places to express it. So we can express the housing views via housing equities. We can express, or we could even express them in rates. We could express the energy view via the crude complex or via distillates or whatever. We can express the transport views via equity indexes. But when we take all of those things and we add up, what we're kind of looking at is we see the energy kind of complex as one which is pretty negative, right? Like we see the energy complex as one which is pretty negative, and we can get into the reasons, the whole host of reasons. We see that as generally negative. When we look at housing, we expect everyone and their mother knows that the CPI lagged and all of that. And so that is going to be a downward pressure on CPI. That CPI will translate into a downward pressure on PCE. So overall, we expect that component also to be negative. Transport is a mixed bag, and we don't have as much clarity on because there are lots of secular issues with transportation, particularly in the US. Basically, what happened during COVID is we created the biggest inventory shortage in motor vehicles in the United States that we've seen ever. And so we continue to basically battle with kind of that shortage. And so that, as a result, has led to a period of persistent transportation inflation that we just haven't seen before in decades. Transportation activity hasn't been very great, so we're kind of more mixed on that. And then I think lastly, on the services component, we don't have a major view, but between the housing and energy parts, I think that you have these meaningful kind of downward pressures on inflation, and those are really like the core components.
Yeah, I mean, one of the things we've written a lot about is how housing inflation has been a blessing. We referred to it as housing softness serendipity, that you've had just enough housing softness, not too much, that you turn into a deflationary spiral and you crush business activity and you get a lot of joblessness in the construction industries. But you've had just enough weakness that it's been a drag to inflation and offset a lot of the inflation that has come from what you didn't mention, which is the good side.
Yeah.
So how do you think about there is... Look, the world is getting to be more dovish. We now have a lack of clarity too for the next at least 4 months because of the October imputations and the zeros and so forth. But how do you think about that last piece in terms of the fact that we have some real goods inflation being driven by tariffs? Do you accept the argument made by the Treasury Secretary that they are inherently ephemeral, that they are a one-time price reset? Or our argument, frankly, and you don't have to agree, which is that, look, if you believe that we had a disinflationary impulse from free trade and from China entering the global trading system and global cooperation, then a reversal to global competition is going to have some trade frictions that are going to endure and some redundancies that are going to endure that make inflation probably more lasting from a goods and tariff point of view.
I think, this is one of the things where, I try to, the way we try to do stuff at Prometheus is we try to find things that we can definitely model with a certain amount of, like a certain amount of conviction, right? And this is one of the things where we don't feel like we have conviction we can really model. We did a lot of work about trying to assess the impact of tariffs, both on the economy and then some work on, whether it would impact inflation. And honestly, it was just really hard. Like it was really hard to figure out because there's no meaningful, high frequency, granular way to really assess that. And so the way we take it is we tend to adjust things very, very fast, the way we do things at Prometheus, right? Like our institutional strategies turn over every single day. Our retail programs tend to turn over every week. And so what we say is, if there's going to be inflation, we'll see it. In support of what you're saying, we have definitely seen a concentrated, or rather a lot of co-movement in the industrial complex over the last 6 to 12 months, where we basically started to see industrial commodities across the globe kind of start to rise in unison. And at the same time, you've also started to see a very key barometer of global industrial activity in the form of chemicals demand from the United States begin to rise very, very dramatically as well. And so, you basically had an industrial economy, at least from a US perspective, which has been doing pretty badly for the last 3 years. But over the last, let's say 6 months, the timely indications in the form of these measures that I just mentioned have started to rise quite quickly. And so those things are definitely inflationary. Those things, when it comes to industrial metals, chemicals, all of these types of products, they really, really go into basically, every single type of construction, every single type of motor vehicle. They really are inflationary in themselves, and so they do form a core part of the inflation barometers that we use, and so we track those very carefully, and so we are seeing an uptick in those things. But I don't think that those components, those goods-based components, are going to be enough to offset the energy and housing components. And so when I do that, that weighting, I would say that I'm more biased towards the effects of housing and energy, driving inflation down, while this thing, along with transport, kind of pushing inflation up.
Yeah. Yeah. The fact that we've had this surge of inflation with energy at $58 is really extraordinary. I mean, I don't think anybody could have predicted that you were going to have enduring inflation and enduring inflation expectations with oil at $58. The only thing that worries me is everybody's on one side of the boat on the energy trade. I mean, I don't know. Is there anybody who you listen to, who you talk to, who's a big energy bull right here without there being sort of a geopolitical event?
I mean, I get that, but the thing is that it's a question of, so first off, where are you going to express it, right? So if you're going to express it in equity land, you might have a tough time, because you know what, like all the people expressing in equity land, like they know this, they're looking at all the data. But then when you actually think about like the fact that, if you're actually trying to express your views in energy futures, the people that you're on the other side of is global hedgers, right? And so they have a real economic function, right? And so as a result, like it really boils down to like, if it depends on where you want to express it. And so when we look at like what's being reflected in, individual energy markets, we think that a lot of the supply is still not reflected in various energy curves. So if you look at the oil complex, we think that, you still have a pretty healthy amount of not a healthy amount, but you still have most of the curves in backwardation. We think that, if you're going to actually reflect the inventory dynamics that are ongoing, you actually transition into contango. And so, that's
Aahan,
not
if you
being
could just take 1 second to explain to people the difference between contango and in terms of the futures markets and backwardation.
Yeah. So basically, when every asset has this, but this is particularly true in energy markets where you basically have a futures curve. And so backwardation is basically, you call it normal backwardation, is basically just a case where, you basically have the futures price. So let's say, 6 months out or 12 months out, where the futures price is lower than the current spot price, right? And so what you can do is you can buy the future, say 12 months out, and if nothing changes, you make money as you begin to converge to the spot price. That's called positive roll. So, a lot of people get confused with the contango backwardation. I like to just use roll. So you get positive roll. The opposite of this case is when the futures price is above the current spot price. And so you get negative roll in that situation. So today what we have is basically a situation where the futures prices are actually they're actually still lower. So you could actually get positive roll. And so I think all of that goes to say, for you to basically have, like, what happens is when you have a lot of supply, like a tremendous amount of supply, curves go into contango. They don't stay in backwardation. And so what we have today is we have a situation where you still have a little bit of backwardation, but they need to go into contango. And that basically reflects the fact that while people might generally be, in the investment community might be bearish, energy, it's not actually fully reflected in the prices of energy. And so there's still space to do that. In equity land, you have a different situation because people have to play in the energy equities and they have to do the discounting. And, at the end of the day, who's playing in the energy equities nowadays? It's more and more pod shops. It's more and more, really intelligent traders that take into account all of this information. So you're not betting against the futures curve over there. You're betting against the other equity guys, and that's a hard game.
Yeah. Yeah. I'm going to guess that there were twice as many pod traders in the energy space 10, 20 years ago than there are now.
Yeah.
I mean, hell, there aren't even oil service analysts anymore because there aren't enough companies. Let's talk a little bit about housing, the other kind of disinflationary force that's out there. It does seem to be, as I said before, kind of a Goldilocks environment from a macro perspective for housing, where you have prices kind of flattish nationally. There are definitely pockets of weakness, but you have rates, being managed down to some degree on the long end, that third mandate, and Bill Pulte's going to be out there buying mortgage backs. How do you think about housing here? And it's another one of those areas, as you said before, everybody and their brother knows that CPI lags and housing, even if housing turns and demand gets better, it's going to be a while before that gets reflected in inflation data.
Yeah, I think that housing, I think it's hard to get away from the fact that the only thing that's really not confirming the housing thesis right now is what's happening with residential employment and broader construction employment. But otherwise, when you generally look at the measures of activity, housing activity is not very great. Sales aren't great, permits aren't great, starts aren't great, completions aren't great. And so when we look at, a broad-based set of measures when it comes to housing, our view on activity is that activity isn't very, very strong. That's translating into weaker builder margins. It's translating into weaker builder profits, all of those things. And so that's really a reflection of the fact that, nominal GDP and nominal spending, which powers consumer, income, has been in a deceleration relative to a short rate that's risen quite dramatically. So as every, incremental unit of new borrowing comes on, it comes on at a higher interest rate level. And so, you do have this situation where I think housing demand is just not great right now. But at the same time, what happens with housing a lot of times, which really like throws people for a twist, is that housing has just this tremendous beta to rates, right? And because of the really unusual mix of like policy drivers and this desire to have some sort of policy normalization and all of this stuff from the Fed, every time short rate markets begin to price incremental easing or tightening, you have basically a response in home builder equities. And so I think the way we look at it is to say that, okay, we understand that how home builders have this inherent beta to fixed income, right? But at the same time, what do we think is going to actually happen to their earnings and their fundamentals? We think that path is downwards. Managing the risk around that path is really like kind of trying to time the fixed income beta and time the price beta. So that's how I would think about it. We generally think that the macro trend for housing and generally like anything cyclical in the United States, right? Like we think that things in the United States that are cyclically oriented are having a tough time. And, housing is probably the most cyclical thing that you can find, other than probably energy. And, generally expect that to not continue to do well, particularly relative to things that are more secularly stable.
Yeah. Well, I mean, what's been supportive of that argument is the fact that we have had 30-year mortgages of 615, 620, and that beta hasn't been there, that big demand. And it's interesting. Can we get the 10-year to 550 in a global steepening environment? it seems unlikely that we're going to have that level of flattening that maybe is required to really get to the kind of absorptions that we need now to get housing prices higher, to get I don't know what gets activity higher. I am the classic example of empty nester, house that's bigger than I need, taxes that are bigger than I need, but I still can't live anywhere cheaper than where I live now because I got a mortgage at 2 7/8.
Right. And I think a big part of to be able to get that absorption higher would be to have some sort of I mean, I'm not even in terms of policy, but like you need some sort of income redistribution, right? Like you need there are only so many houses that people like us can buy, and so the question becomes like, when do you have people that are more typically working in manufacturing or in residential construction and things like that, being able to afford houses? And there's definitely an affordability problem in the United States. And so, like, I think the biggest impetus you could have for increased housing demand is, some sort of redistribution of income. But without some sort of policy impulse to do that, I don't really see how that happens.
How do you kind of a last question here, as we talk about housing, it makes me think of the wealth creation that has happened, right? One of the things that has held up spending, as everybody knows, is the top 10% that have benefited from the increases in the S&P, have benefited from the increase in their housing wealth, have really held up spending. If for whatever reason markets roll over, if for whatever reason you get a sustained 20% drawdown in markets, how do you think about the reflexivity to the economy? And do you think that is something that is kind of an overstated worry or something that people don't adequately appreciate?
No, I think it's much bigger than it's ever been in history. I think that, housing wealth is kind of, not housing wealth, equity wealth today is now such a big part of balance sheets. And what we have to also recognize is the fact that, about 80% of the spending comes from the top 25% of consumers. And so, the top 25% of consumers are asset owners. And so if you do have a very, very material change in equity prices, you are going to have impacts across the board. And then you have to also think about the fact that, a lot of investment today, business fixed investment, is also coming from these really, really high performing equities. And so if you have the aggregate equity market sell off really, really dramatically, you're going to have the consumption effect, and you're definitely going to have reduced big business fixed investment, which is one of the most time tested relationships there is. So, I think that one of the major things that you have to do in today's markets is, this is not to say that like old ways of doing things are not valid anymore, but one of the things that made a lot of macro careers was to really, really to focus on credit and debt cycles. But as we've kind of gone through the 2000s and into the 2010s and to 2020s, you basically had the importance of kind of equity markets to the macroeconomic landscape just become larger and larger and larger. And so I think that you have to have definitely a clear tracking and clear implications of changes in equity markets to your macro outlook. I think it's just essential.
Yeah. I mean, I think that's a great point. We can leave it at that. That's a great point that you make. Meta may be able to keep their capex, but if you're a company that isn't profitable and you're relying on the capital markets in order to keep your capex up, if markets roll over, all of a sudden your ability to keep spending goes to zero.
Exactly. If you can't raise new money, you're not going to be able to do any more capex.
That's when the music stops. All right. Awesome. Why don't we conclude it there? Drew, thank you very much. Aahan, thank you very much for being on. I hope we can do this again one day.
Thanks, gentlemen.
Would love to. Thank you, guys.